Well, one of the noted investors, fund managers, the chief investment officer and the co-chairman of Bridgewater Associates, Ray Dalio, has today written a very interesting LinkedIn post where he has actually gone ahead and given an answer to a question that's been actually on a lot of investors' mind lately. What he is saying is that Ray Dalio, number one, he's titled the article saying, "Are we in a stock market bubble?" So what Ray Dalio says, and he himself says, that he's actually seen quite a few bubbles in his investing career, and he has studied quite a few of them in history. So what he says is that he definitely understands what is a bubble, and he's tried to systemize it into something known as a bubble indicator that he has developed himself, that he uses to monitor and get some perspective on how each market is behaving. He now looks at it, and he looks at most markets through this particular bubble indicator, and what he has shared as far as his readers are concerned is that what it is currently showing as far as US stocks are concerned. Now what he is saying is that what he means by a bubble is an unsustainably high price, and he measures it using 6 measures or 6 questions that he has coded into his particular proprietary bubble indicator. Number one, how high are prices relative to traditional measures? He also asks if prices are discounting unsustainable conditions. How many new buyers have entered the market? How broadly bullish is the sentiment? Are purchases being financed by high leverage? And have buyers made exceptionally extended forward purchases to speculate or to protect themselves against future price gains or losses? Now what he is saying is that his bubble, which he has actually gone ahead and backcoded it for a very long period, in fact over 100 years, he says that the aggregate bubble gauge reading currently is at 77th percentile today for the US stock market overall. What he is saying is that the same bubble indicator, when tested, showed a 100th percentile read for the bubble of 2000 and the bubble of 1929. Now what he is saying is that, however, one should not get carried away. What he is saying is that there is a very big divergence in the readings across stocks. He says that some companies by these measures are in extreme bubbles, and he's noted that emerging technology companies are definitely in a bubble, while he says some stocks are not in a bubble. He also says that some of the other companies, in fact, are still offer quite a bit of value, and what he is saying is that overall he has actually created a basket of the bubble stocks in order to keep a close eye on them. Overall, what he is saying is that while he cannot share how exactly the indicator is constructed, given the fact that it is proprietary, what he is saying is that he has actually gone ahead and shared quite a few readings. It's a very interesting article. One of the great minds has actually gone ahead and given a thumbs up, saying market at this point of time, while certain stocks, especially emerging market technology sectors, emerging technology companies are in a bit of a bubble, in fact extreme bubbles, he believes that there is still some value that is available as far as this particular market is concerned for the US investor.